Well, Happy New Year and welcome to HYROX's weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HYROX, is also with us, as is our financial planner and wealth forecast specialist Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, let's start with a quick review of our themes for 2017, which we covered at the end of December, or in our last meeting, that is. We think that our strategy of having a tactical perspective to investing becomes even more important in 2017 because of the even greater levels of uncertainty imposed on us by a number of developing factors. If the new U.S. administration is able to push forward some of its tax proposals and spending initiatives, there is a greater likelihood of inflation, and the expectations surrounding this will change the dynamic in financial markets. To a large degree, bond markets have already been showing us this. Well, higher bond yields and higher short-term rates in the U.S. with 2 or 3 more Fed rate increases will increase the cost of borrowing, which in turn could present us with a whole new set of risks with global debt levels at record highs. With improving economic conditions and a lower tax burden, it is expected that earnings will grow at an approximate rate of 11.5% throughout 2017. And it does remain to be seen how the new populist revolution plays itself out, but first we had Brexit, followed by the election of Donald Trump, and now we had recently had the referendum in Italy. And soon we will get elections in the Netherlands and France and later in the year in Germany. And there is very real potential problems for the euro, and the U.S. appears to be moving its alignment away from China and closer to Russia. Well, the old rules for balance and diversification are no longer working in their traditional manner, and long-held relationships between asset classes have been breaking down. Now, this was an important part of the development of a tactical investing model to complement our fixed income and global equity models. The 3 models that we use to get balance in our portfolios allows us to have a greater flexibility and depth over the standard buy and hold strategies, and this will be even more important as we structure our investing process for 2017. Now let's talk a little bit about how all this played out over 2016. In our fixed income model, we adjusted our duration, the length of time to maturity of the bonds that we owned, in early September, as we noticed that government bonds were no longer performing as they should have based on our research on the correlation between stocks and bonds. Now, this helped us a fair bit in the post-election bond sell-off. Also adding value and protecting our capital was a shift we made in early November, where we sold our fixed-rate preferred shares and bought non-bank rate reset preferred shares. Yes, the same ones that hurt retail investors the past 2 years. Up until early November, HYROX clients did not own any rate reset preferred shares and therefore were spared the decimation that occurred in these securities as interest rates fell. But our in-depth research in the fall on these highly complex instruments concluded that the implied credit spreads on these rate reset preferred shares were very cheap, and that as interest rates rose, the value of those preferred shares would rise. And so they did through November and especially in December. Our investment-grade corporate bonds did very well over the year, but gave up some ground in the last 2 months of the year. And lastly, in fixed income, and our high-yield bonds added value right through the year. In our global equity model, as we have maintained for the last year and a half, U.S. equity markets have remained expensive on a number of valuation metrics. As U.S. equity comprised approximately 53% of the All-Country World Index, ACWI, upon which we benchmark our performance, and given the number of significant risk events in the global geopolitical realm, we have attempted to reduce risk by being underexposed to this asset class relative to the benchmark. In a nutshell, this has reduced risk and the potential for volatile swings in the global equity model. Now, it does also mean, however, that we have participated less in some of the most recent upside in U.S. equity markets, preferring to allow other model adjustments to add value and growth with a less risky profile. Now, we believe we'll get better buying opportunities in some global equities in the first half of 2017 and remain disciplined in our approach to adding global equity risk. Well, in our tactical model, most of our outperformance on the year was driven by our in-depth research, our ability to trade on a block basis, one trade for all accounts at the same time and same price, which is our discretionary basis, our timing and our access to all corporate bonds, including high yield. I won't go on about each trade, but we would highlight a few. A threefold in Paramount Energy in January and February, a double in Rona shares that were bought by Lowe's, a double in perpetual energy bonds, and two companies we own, Connexus, which was our largest holding, and Direct Cash, that were both acquired on the same day on October 3rd of 2016. While we're very pleased with the performance of our tactical model, we think it will continue to add value across 2017. We would also note that we cannot guarantee similar returns in the future. What we can guarantee is that we will continue to look for opportunities on an ongoing basis to help add value to our portfolios. Well, for comparison purposes and to gauge the progress of your and our portfolios, we look at a combination of two indices as part of a balanced portfolio. Our benchmark equity index is the All-Country World Index, and we use the ACWI ETF to monitor how it is providing equity returns. The total return, including dividends for the final quarter of 2016, was 1.05%, which gave the full year of 2016 a total return of just a little under 8.5%. The two-year return was a minus 0.95%, so almost a minus 1%, and the three-year return about 3.75%. The five-year return just a little under 9.5%. Our fixed income index comparison is the Canadian Bond ETF XBB. In the final quarter of 2016, with all of the significant downward move in bond prices, the fourth quarter had a total return of a negative 3.5%, and that gave the full year of 2016 just a little over 1.25% total return. The two-year at 2.25%, three-year 4.25%, and the five-year just a little under 3%. Now, if we combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total benchmark return for a 60% equity and 40% bond index combination for the fourth quarter was actually a minus 1 and a little bit percent. For the full year, 4.63%. For 3 years, about 2.75%, and 5.67% over the 5-year period. A more bond-oriented, 60% fixed income and less equity-oriented portfolio actually had a pretty steep decline in the fourth quarter of just a little under negative 2%. The 1-year return just a little under 3%, the 3-year return also just a little under 3%, and the 5-year return 4.34%. All of those 1-year, 3-year, 5-year returns are on an annualized basis. You can use this chart as a comparison to your portfolio return, and all our clients should now have received their year-end reports with their portfolio returns, and this table is included in that for your comparison purposes. Well, over the course of 2016, the total return of an actual High Rock client portfolio with a balance of 60% equity and 40% fixed income and a weighting combination in our models of 50% global equity, 40% fixed income, and 10% of our tactical model is well ahead of the comparative benchmark for 2016. Now, the benchmark, as I stated before, consists of the total return on a daily basis of a fully invested buy and hold strategy of 60% of the All Country World Index ETF and 40% of the Canadian Bond Index ETF. And both numbers are after fees and other MER costs. As well, I am required to remind you that past performance is in no way a guarantee of future performance, but as you all know, at High Rock we work darn hard to get the best possible risk-adjusted returns for our clients and ourselves. Well, so now let's look at the risk. Importantly, let's look at the return per unit of risk, and that's in the orange row. On the far right, the Canadian high yield was the best performing asset class at 14.36 times, followed by the TSX at 9.6, and then the High Rock Private Client came next at 6.64 times. From that, you can see, and as we look at this chart with a more graphic presentation, the return on the vertical scale and risk increasing to the right on the horizontal scale, the High Rock portfolio not only outperformed the combined ACWI XBB 60/40 portfolio, but also used less risk to do so. So all in all, we've significantly beaten our benchmark with this particular model, this particular portfolio, grouping of models. And the headlines were very explicit about the one-year return of the TSX being the best performing market in the developed world. However, the two-year total return was still negative. The TSX was the worst performing market in the developed world in 2015. Well, that swing itself adds considerably to the risk in having a large weighting of this asset class in your portfolio. But we did advocate adding to Canadian holdings at the end of 2015, and our portfolios were overweight Canadian equities relative to the benchmark through the year of 2016. Now, our High Rock Canadian High Yield Bond Fund actually beat the benchmark one-year return of 16.13. It also outperformed the TSX. Now, all of our clients were overweight high yield and Canadian companies relative to our benchmarks. So that's how our portfolios performed over the course of 2016, and I think everybody who receives their client summaries or has received their client summaries as they review them should be moving forward. Now, a number of clients obviously joined during the year, and some of the results will not necessarily be complete. So all of this, of course, is subject to our more of a time constraint. So as you're with us longer and we take advantage of more opportunities down the road, your portfolios will obviously start to come into a more relevant shape. Okay, let's go back to our themes for 2017 and look forward a bit. Results from the Bank of Canada's Winter Business Outlook Survey indicated that business prospects have improved following 2 years of overall modest activity. The responses reflect building of domestic demand, supportive export outlook, and an expected recovery in energy-related activity. One thing they did note was that inflation expectations, which is part of our theme, or our second theme for 2017, have edged up from a low level and remain concentrated in the lower half of the bank's inflation control range. So rising inflation expectations, and this is something that we're monitoring closely. As so have been the bond markets. Bond yields have been rising. Bond investors are now expecting more inflation and want higher yields for protection from that inflation. That's forcing other term borrowing costs like mortgage rates higher. The yield curve in Canada has steepened since November, with 5-year yields higher by about 40 basis points, which is almost 0.5%. However, until the Bank of Canada sees inflation moving above its 2% target, it is likely to hold the overnight rate at 0.5%, which will hold prime rates down, and this is what variable rates are priced off of. Which begs the question, should you stay with a variable rate mortgage or move to a fixed rate? Well, I had a client asking me that question this week. It's going to be important to watch the Canadian CPI data as it comes out over the course of the year for clues to the Bank of Canada's interest rate policy. Total CPI is currently measured at 1.2%, but as I said, the Bank of Canada's target is 2%. So for the time being, the bank will hold rates steady and prime will stay at 2.7%. But if inflation does pick up, and it is expected to do so, the bank may, in fact, raise rates. Now, historically, it has made sense to stay with a variable rate because when the economic cycle runs its course, variable rates will eventually fall again. If this is agreeable to your cash flow and well forecast. However, fixing the rate may also give you peace of mind. So it is best to look at the question in the context of your total financial plan. And of course, when we look at your wealth forecast, we will always assist you in what is best going forward for your personal situation. Well, higher borrowing costs will also make servicing the record amounts of global debt more expensive. The proposed U.S. budget deficit will certainly add to this, but it is hoped that better economic growth down the road will allow for this debt burden to be manageable. Something else that we will want to be paying attention to as we go through 2017, because if that economic growth does not materialize to the degree that it is expected, we are going to want to be more flexible and, again, more tactical. Well, investors are confident too because clearly stock markets have built in a robust 2017. Even with earnings already estimated to grow at about 11.5% next year, the 12-month forward-looking price-to-earnings ratio is at its highs again at 17.1, well above that 10-year average at 14.4. And finally, of course, as I mentioned, the wild card, geopolitics and trade protectionism. What happens with Brexit? How does the new U.S. administration align itself with Russia and China? What happens to the euro? Will it survive the elections in the Netherlands, France, and Germany? And what happens next in Italy? We do not know. No, we do know that populism is on the rise because the middle class in developing countries has felt left behind in the race toward globalization, and the backlash has probably only just begun. Lots of pending questions, and we will have to wait for the answers, and this certainly leads to a great deal of potential uncertainty requiring even more flexibility and, tactical readiness. And we will continue to add to our models as opportunity presents itself, and we expect to get plenty of opportunity in the first half of the year. And we will be preparing our strategy with continued deep levels of research as we did last year, keeping in mind that our tactical approach allows us to add value and reduce risk to give us the best possible risk-adjusted returns. And now I'm going to just bring in Paul, and hopefully, Paul, do you have anything you want to add today?
Well, not a lot, Scott. Thanks. Given the time of year, it's kind of first week back at work after a holiday break, but I would just highlight again that we'll continue to do our work, and for clients who joined us partway through the year, they may have missed some of our more powerful trades that gave us some good performance. But again, it's the fact that we're doing this work constantly and trying to originate ideas that fit in with our risk parameters to add value to the portfolios. So we'll keep doing that and searching. I've got one idea already. I just put an order in on that I think could be pretty impactful over the next year. Other than that, I do wish everyone a Happy New Year, and thank you for your trust in High Rock. That's it.
Thanks, Paul. All right, if anybody has any questions, this is the time that we'll certainly like to hear from you. All right. Well, it's early in the year, so maybe no questions today. But if you are listening to the recorded version and you do have questions, of course, please feel free to send us an email with your questions. Last week I did have that mortgage question, and we certainly do want clients, if there's any issues that they have, to be making sure that they get in touch with us. Happy that you've been able to tune in for our first webinar of the year. We're looking forward to plenty more, and we will be back next Tuesday with another version. And until then, this is Scott Tomlinson signing off.